Hello, Yatin. Can you hear me, Yatin? Yatin, are you there?
Yatin, hello, good evening. Hello, Yatin. Hello, Yatin. Hello, Yatin, good evening.
Yes, good evening. Good evening, Deepak. How are you?
Yeah, hi, Yatin. I'm good. Along with me, Sangam is here.
Hi,
And
Sangam.
Hello.
Pratibha Goyal is also here, who is moderator of the session. Sangam is with me. And Sushil sir will join in the second half, or he will join now?
Yeah, he will join in 15-20 minutes.
So first you will take session?
Yes. First I will start.
Okay.
Yatin, you will take Ind AS 116, Lizis?
Yes.
Let's wait to 6 to 7 minutes. Let's wait for the participant. We will start 6 o'clock sharp. Is it okay?
Yes, absolutely fine. So let me know how to share the video.
There is a see, Yatin, there is a button in the middle, bottom of the screen, share option. You will see green color button, share screen.
You can do testing also. You can do
If-
testing.
If
Share
you click,
right now. Share
if
the
you click
testing.
share button, now you will be able to share your screen. And for your video, there is a button of stop video. I think that is not open. Like just untick that stop video. Your video will also come.
There is a bottom, left hand side bottom. Yes, your PPT is visible.
It's a screen visible.
Yeah, it's visible.
Great.
Now you can open your video also within. Now you can see at top on your left hand side, there is an option start video. By clicking there, your video will also start. Yes. Now your video is also appearing.
Okay.
I think we can make our session interactive. You can ask the question through participants, and they can revert in chat box.
Okay, but I think I am connected through my phone, so that is the real issue.
No issue with us. See, what I'm trying to say is that participants won't be able to reply you. So, in order to make interactive, you need to ask queries, and so that they can reply by way of message, text message. So they can reply in the chat box or
in the
Q&A.
chat box, they will say yes, no, kind of reaction will come to know from the participant. That will make the session very interactive and helpful to get the feedback from the participant whether they are understanding such point or not.
Okay.
Also, there is one Q&A box also at bottom, and participant can ask their query there. And after the end of the session, we can take some query out of there. Is it fine?
Okay.
Q&A you will see in the screen only.
Yes.
And
but I am not able to see my own screen.
No issue. Q&A we will speak later on for you. And we are live on YouTube as well. So we will get queries from the YouTube. So that also we will ask from you. No issue in that.
Okay.
Currently, your slide is not shared. Is it?
It's not shared.
Yes. Earlier you shared, but it disconnected.
Let's wait for some time. Please share it after 5-7 minutes when you start your deliberation.
So I have my PC also connected and my phone also connected. So I'm sharing my slide through PC and using my audio video through
That's
my
okay.
phone.
That's
Yes,
okay.
it will work.
So
So
I
I
can,
think
yeah. So
PC you need
one
to
of you
connect
might.
again.
Acha, I'll just do it.
Yeah, then we want our session in like such a manner that there should be lots of examples so the participant can understand the practicability of this Ind AS. So I request you to kindly take some live examples and ask some questions to the participants so that they can interact in the session.
Yeah, definitely,
And
definitely.
I think there has been
Don't
some
worry about it.
change in Ind AS 116.
I think that change is not yet approved by the ISB, I think, ASB. Is it? I think there is some change due to COVID-19 release. Is it approved by ICI right now?
So there is the summary of analysis which I have also placed in my PPT. So it's
Okay.
only talking about the discussion and what it might impact. So as of now, there is no concrete guidance available on it.
Yes.
Okay.
It
It's
is.
only the discussion part of it.
Yeah. It is under discussion right now. Might be in 2 and 3 days it will be finalized.
Yes.
Because once Sanjeev Singhal sir, who is a Central Council member, came in our session and discussed about the leases.
Okay.
He told at that time it is under consideration. Some modifications are going to be in this, but that's because of COVID-19.
Yeah. I think lots of things are there. I think, like what I was actually like referring to even the ICOFER scenario, like internal control over financial reporting scenario, will might also change. I think that is something which was new learning for me, apart from the impact on the financial statement. So
Yeah.
the how the company is trying to place good controls on the integrity of the system. So this is what something which is thing to look for each and every one of us.
I think mainly the treatment of lease which will not paid by the lessee is an important factor to book in financial statement. How
Yes,
to
this,
account for
yes.
that is one of the very important thing.
And I think we have
Yes.
time till 8:30. So like
Okay.
for yours and Sushil sir session. So
Yes.
you both see like how much time you will need and how much time Sushil sir will need. Because maximum we will go by 8:30.
8:30.
Because after that participants will not be there.
Yeah, I can understand. Don't worry. I think we have scheduled a
Two,
time in a manner which so that like we try to cover it within 2 hours and then adding to some our question and answer section if there are.
yes.
Kindly
So I
also
was removed. I was. It's showing that I was removed by the host, so I'm not able to join. So I don't know
I
why.
think I have removed your ID. Can you please do one thing? Uh, you have the panelist link mail. From that mail, can you please join it? Or wait.
is a webinar ID and password at the bottom of that email. Kindly join from that webinar ID, then we will add you as a panelist.
Just a second.
Yeah.
I'll be putting my video off for a moment.
Yeah, sure.
Deepak ji, meanwhile, give the information of upcoming program of Shiv Shri Ravi Shankar ji to use the time in a better manner.
Let's increase 5+ few participants and we'll give it so that it should reach to maximum people. Nazmi, can you see my screen?
Yes, I can see your screen.
Yes,
Friends,
yes, the screen is visible.
Yeah, friends. On Friday, we are bringing up with one motivational program for all of our viewers, those who are watching us. So because as we promised, we will try to bring one program which will be on the motivational or which will be on our personal life. So this Friday we are coming up with the motivational program, and me and Sangapji jointly with Art of Living Foundation, which is founded by the Gurudev Sri Ravi Shankar ji, we are organizing a stress elimination and mindfulness session for the finance professional and students. And it is not only for the finance professional students, it is for the everyone. So I would suggest that you should watch this program along with your family. uh, Program will be on the Friday from 11:30 to 1 p.m. And I would request again that please inform this about this program to all your family members. Please share this message along to all the family members, so that maximum people can take the benefit of this program. Art of Living session is very good session. There are benefits of there are very few benefits that I mentioned. There are a lot of very benefits of Art of Living session, like it reduce the anxiety attacks, builds our self confidence, lowers our cholesterol levels, help to reduce heart disease, helps to weight loss. It also helps us to increase our concentration level for the students and as well as for the professionals. So it is going to be very good session where 12 to 12:30 Gurudev will be giving guidance for the meditation. So request you kindly join this session and inform others as well about this session. It is going to be very good session by the of the Art of Living. So we are trying our level best to bring something new for all our viewers, all our participants. So considering this, we have asked Art of Living team to come on our platform and give one deliberation on this topic. Link of this session I will share in the chat box. From there you can join it. Let me share the link with you in the chat box so that you all of you can join our this session. It's very good session. Once again I'm telling you, please join it.
Friends, we have a capacity of 500 on Zoom, so kindly register yourself as soon as possible, because only you can see live and ask your query through Zoom only. So we request you to kindly join as soon as possible through this link and share this link with your friends also, so that maximum people can get the benefit of this session. Deepak, I think it's already 6:07, so we should start the session.
Yes, we're starting. And
Yatin, are you
those
able to just a minute? Are you able to share your PPT?
No, I think I have to register with my different ID. So I have just texted Deepak ji with my another ID. So just allow that ID to share the
okay,
PPT.
okay, I'm just doing it.
Friends,
Friends,
yes, sir.
those
Start.
who are not able to join on our Saturday's program, Friday's program, request you kindly join it from the YouTube as well. It will be available on the YouTube. But please come soon because it start at 11:30. So we'll start sharp 11:30. So those who want to join it to the Zoom, request you kindly come on the time, and those who are not able to join through Zoom can join on the YouTube channel. Now I think I need not to tell you the YouTube channel link. Everybody knows our YouTube channel link. And one more thing I would like to share. Yesterday, more than 400 participants has took the test of international taxation, and many of participants has got very excellent marks. Few participants has got 100% marks, and we have got many messages from the participants that test was wonderful, and the lectures and session was also wonderful because of the excellent deliberations during the session. They were able to clear the test. So more than 400 participants has taken test yesterday. Certificates to all the participants will be issued post lockdown. Once we will open the lockdown session, that certificate will be issued. Good evening, Sushil ji. Are you there?
Yeah,
Sushil,
good evening, sir.
can you hear us, sir? Your video is not coming. You can start your video as well. Yatin, I think I've given access to you for your another ID. You can start. I think your screen can be.
Yeah, good evening, sir.
Good evening, sir. Good
Sangam.
evening.
Good evening.
Good evening.
I think his screen is already shared.
Yes,
Now you can start from.
Yeah, we are starting from our today's lecture. Hello, friends. Good evening, all of you. Good evening, all the participants and friends. Today we are on the day 5 of our 8 days Ind AS and IFRS series, and today we will cover Ind AS 115 and 116. And Ind AS 116 leases will be taken care by the Yatin ji, and who is a fellow chartered accountant of our fraternity, and 115 will be taken care by the Sushil ji. Once Yatin will complete his deliberation, and Sushilji is having experience of more than 14 years in DS and IS field. More details about Sushilji and Yatinji will be given by my dear friend Sangamji. Friends, just want to inform you that we have already completed our international taxation series, and for that series we have got very good response on that series. And yesterday the test has been completed by more than 400 participants, and for IFRS test date we will announce in a day or two when test will be conducted. That date also we will announce soon. And one program details I have already shared a few minutes back, that on Friday we are bringing up one Art of Living session, which will be organized by the Art of Living Foundation, which has been founded by Gurudev Shri Shri Ravi Shankar ji. And Shri Shri Ravi Shankar ji will also give his deliberation for half an hour from 12 to 12:30. So request you kindly join that session as well, because it will help all the professionals to deal with the stress, anxiety, all the problems that we are facing during our professional life. Now, without taking much time, I will request you to Sangamji to give the brief introduction of Sushilji and Yatinji so that we can start our deliberation.
Thank you, Deepak ji. Good evening, friends. Myself, Sangam Agarwal, and I express my sincere thanks to Sushil Fogatji and Nitin Dangji, and including all the participants, those who have joined through Zoom and as well as through YouTube. Friends, I am very thankful to all the participants joining this series through Zoom and YouTube. Our actual strength is our participant, because without our participant, we are nothing. And I express my sincere thanks to all the participants. And friends, now going on the first session, as Deepak ji told, first session will take by Jatin ji, and he will take session on Ind AS 116, which is basically leases, and which has a very important topic nowadays. And there is some soon there is amendment in that by the ICI also. So friend, now I'm going to read the brief profile of Yatin ji. Yatin Dangji, chartered accountant with over 5-year experience as external auditor, with extensive experience on preparation of financial statement prepared as per the IGAP, Ind AS. Key industry knowledge is basically retail sector, white paper manufacturing, and logistics sector. And Mr. Sushil Fogatji, chartered accountant with over 14 years of experience, is working as external auditor with companies, examination of financial record and financial statement prepared as per IGAP, Ind AS, IFRS, and US GAAP. And friends, Sushilji will take Ind AS 115, which is basically revenue from contract with customers. Friends, both Ind AS are very important in our day-to-day life. So I request you all the participants to have extra focus on this session, and they can ask their queries in Q&A session. Whenever any speaker asks any question, they can revert in chat box. Chat box is already enabled. They can reply their answer in yes or no, or they can also write a small logic of their answer. We will try to make this session very much interactive, so that we can have a better knowledge of this both Indias. Now, not taking much time, and request Yatinji to start the session and handing over this mic to Yatinji. Now over to Yatinji.
Thank you, Sangamji.
Thank you.
Thank you so much. And thank you, Deepakji, for giving such a wonderful opportunity to be part of your for part of the series. And I think this is something which is more value creating in the time when there is a lot of uncertainty going around in the minds of every people. So I hope that everyone out here is safe and really taking good care of your health and your family members. So my best wishes and prayer are with all of you. So today, this has been the new series, like new amendments which has come across the globe, and I think we all are aware that like IFRS is something which has been converged into the Indian accounting standard like a few recent years back, and then there have been little like upgradation to the standard by the IFRS IASB board. So these two standards are very new, and the Ind AS 116 and Ind AS 115 are actually the adoption of IFRS 16 and IFRS 15. So these are actually bringing a new fresh model on how to really account the transaction which have earlier been recorded in a traditional way of accounting, right? So, specifically talking about Ind AS 116, so it got affected from financial period beginning from 1st April 2019. So, I think that what I really thought to share with you my own practical experience that quite a recent time that I've been doing an audit of companies which are counting period ending on 31st December, right? So on those so there was a deliberation whether or not the accounting standard 116 will be applicable to them or not, because their accounting period started from 1st January 2019 and not from 1st April 2019. So the standard is specifically talking about those accounting periods starting from 1st April 2019. So I thought I'll share this insight with you all, because I faced the practical situation where the company itself wanted to apply the accounting standard from 1st April 2019, but because their financial period was begin from 1st January 2019, at that point of time, the standard were not applicable to them. So I thought this will might ease out some of your concern related to the when and how this standard is going to be applicable to your respective clients and the entity that you are working with. So moving forward, before I move forward, I just wanted to share the transition aspect of Ind AS 116. So there are two approaches which Ind AS 116 gives us to apply Ind AS 116 into your company. So the first is the retrospective approach. So what does retrospective approach means? So retrospective approach means where you will be going back into the back dates and changing the comparative figure in itself, right? So we won't be just starting from the day, like from 1st April 2019. We have to go back to a year back and then apply that standard from that. So we need to change the comparative figures. And the second approach is the prospective approach, which is modified prospective approach, where we need to just apply the standard from 1st April 2019 onwards. So I thought this give you just a brief about that, how this standard is going to be applicable in our scenario. However, I feel that most of the clients and most of the companies would have already started applying IFRS 16 or Ind AS 16, Ind AS 116. So I think that so I've not included that particular slide and more detail about the transition approach, but just thought to share with you so that you are aware of how to approach forward. So today what we will be covering why
Hello.
this change has been brought into.
Sorry to interrupt. I have just a query. Can I ask?
Hi Pratibha, maybe we can have a query towards the end of the session, or it's something which is
actually it was related to the retrospective and prospective approach.
So maybe we can come to the after the end of the session. Maybe let me complete
no
the
issue.
slide and then we can share the question and answer session. Is it fine?
Yeah, no issue.
Yeah, sure. Thank you. So coming to the agenda, like today, so when I was really preparing for the today's session, the thought that it came to my mind that so that I should be able to equip you with the sufficient knowledge of the standard so that you can actually take up this project in your own workplaces and be empowered to apply this standard without any hesitation. So I think before we go forward with the study of the Ind AS 116, so I thought let's have a understanding that why there is a change, why it has been brought into the picture, why the old scenario was not complete enough for the user to perceive the true value of the company. So just to understand, so I have prepared a slide which shares which is, I think, which give you a brief idea how it looks when pre and post scenario from in terms of recording leases. So when we talk about leases, we always come around accounting standard 19, and I think at that point of time the only issue that I used to face was with respect to the lease equalization. I think we all feel that how this is going to work, but it has accounting standard 19 used to have a bifurcation into finance lease and operating lease. So we all understand the operating lease aspect, where there is in other expenses we used to see the rental expenses being there recorded, which used to be such a higher number, which used to take a lot of cost involved, right? So there will, like, suppose there are so many there's a company which has owned lot of warehouses to store their inventory, and that the rent has to be paid to the vendors for occupying the right of use of the asset. So there is a, every month there is a cost which company has to pay as a rent, so that is something which is a traditionally we used to do. And coming to the finance part, then we used to record asset and liability, right? So in India's 116, so there is no two segregation of finance lease and operating lease. So basically, India's 116 is actually talking about single accounting model. So keep this in mind that the India's 116 has drastically changed for the perspective of the lessee and not from the perspective of the lessor. So lessor is more or less same, but however, in terms of lessee, it has drastically changed. So why it has been changed? That why this single accounting model has been adopted, where the companies are advised to record assets and liability in their balance sheet. So guys, we must be aware that the company enters into a contract of a lock-in period of maybe 3 years, and with the right with an option to extend, or with the option to not to extend for another, maybe say a period of 3 years, and then again a period of 3 years. And for that, huge cost goes into the entering into a contract, and most likely all the future costs, like all the future rental expenses, are not incurred in the balance sheet. It goes either into the notes to accounts as a contingency note, or it's just goes unrecorded. So we cannot foresee that what is the real obligation lying as on balance sheet date. So this accounting policy, single accounting policy, has done away with the concept of operating lease, and give a fresh perspective that everything is like a finance lease. Just to give you a so, to ease out your concern that what is India's 116. So let's treat as if like India's 116 is just like accounting for the finance lease, where we will be recording assets and liabilities on a balance sheet date, and then we will be amortizing the assets, and then upbringing we will be using the time value of money to record the finance income. So from the perspective of P&L, there will be a drastic change as well, right? So if we see that in previous scenario, there was used to be huge rental expenses, right? And there was no depreciation. Finance income concept was not there, and only in finance lease it used to be there. So when we come into the India's 116 scenario, what happens is that we have very reduced rent expense. So rent expense, you may be thinking that, why rent expense is there? How there's basically, like, India has some exemptions because of which rent expense might come into the picture. So there are a few exemptions available in the India, which there is a low value of asset, which where the India's voluntarily, or says that, you may exclude it because it's a short period leases, so you might not need such extensive model to create lease accounting. So friends, I'd like to just bring your attention to this aspect, that, because of applying India's 116, our profit is going to drastically reduce, and our EBITDA thankfully will increase. So why EBITDA will increase? I want you to think over this aspect, that why EBITDA will increase. So once we think that, what is the definition of EBITDA? Is earning before interest, taxation, depreciation, and amortization. So basically, what will happen when I go to the calculation of EBITDA, the depreciation part, which I derive from amortization of right of use of asset, or the assets of from the lease asset, will actually be excluded from my PBT. So when I exclude that depreciation from my PBT, so then naturally my EBITDA will increase. However, in my previous scenario, when I used to reduce the when I used to calculate EBITDA in previous scenario, what I used to do is that rent expense was never excluded from my PBT, because of which my EBITDA was always down. So I think this is something which is going to be a drastic change from the management's perspective, that, by applying India's 116, their EBITDA and their financial performance is definitely going to increase. So many of clients, they want their EBITDA to be very strong, so that they can present over to to the bankers and to the investors, that, how good their company's operations profit are. So I think from that perspective, it's more of a, like, giving more benefit to them to show the correct picture of their financial statement. So if you look at this slide, I think this explains in incomplete, that how my profit and loss is going to move from over a period of lease. So if we say that, the depreciation, if we, in normal scenario, in old scenario, the red line is the lease rental line, that is the expense that, company used to book into their profit and loss account. However, because of the introduction of India's 116, this lease rental is almost diminished, and in replace of this, there is an interest expense and the depreciation expense. So the accumulation of interest expense and the depreciation expense is equal to the total lease expense. So we will see that in the start of the lease period, there will be huge expense which company has to incur because of India's 116. This is only for the PBT perspective and not from the EBITDA perspective. So the company has to incur huge expenses as compared to their previous accounting standard. However, when they move further in time, when they towards the end of the lease, then I think then the scenario will gradually decrease. So in the totality of the length of a time, that then there will not be any gap.
Jatinji, your PPT is crossing the not coming in the full screen mode. One thing. So if you can adjust the PPT.
Is it fine now?
Yes, yes.
Yeah, and lecture you can take in English or Hindi, both the language. We have no issue for that.
Sure.
So whatever is comfortable from your side, you can take lecture on that.
Sure. So friends, this is what I really wanted to share, that why there was a need to come from the old scenario to the new scenario, where we will be recording India's 116 in our balance sheet in itself, in our balance sheet as on balance sheet date. Right. So moving on to the further, we need to understand that, what are the mandatory exemptions and optional exemptions which accounting standard talks about. So mandatory exemptions are use of mineral oils, natural gas, similar non-regenerative resources, biological assets within the scope of India's 41 Service Concession Agreement, India's 115, licenses of intellectual property, India's 115, rights held by lessee under licensee agreement, India's 38, and also just as like I shared earlier, also there are some few where there are two optional exemption: short-term lease of less than 12 months, which are so here there is a one catch in it. Uh, we cannot pick and choose in terms of applying optional exemption on short-term leases. We have to apply this on the same class of asset. So let's say vehicles generally are taken either on a short-term leases or maybe long-term leases, depending on the arrangement that they have with the banks. So if one asset is falling less than 12 months, then I cannot exclude that particular asset if the entire class of asset I'm using the India's 116. So I cannot pick and choose within the same class. So if I have to choose to apply short-term leases, then I have to apply on the same class of asset, right? So second is the low value asset. So low value asset, there is little deliberation about it, that what constitute to be the low value of asset. However, from my own experiences and also US CPA, if you I was referring to US GAAP. So they say that any value of less than $5,000 is low value asset. However, they did not define what class of asset they are referring to, or which asset they are specifically talking about. However, they only said that any asset of which value is less than $5,000 is low value asset. In India's 116 and even in IFRS, there is no definition given which defines low value assets. So from my own experience perspective, I would say all those furnitures, chairs, which are taken on leases, so I think these will come into the picture of low value assets. So moving forward, so when we now it's about the identification of lease. How do we really identify lease? So we need to understand from the contract of an arrangement. So what does a contract should definitely have for us to say that it contains leases? There are four things which a contract should convey to us: that the right to control the use of the asset, identified asset, period of time, and consideration. I think so. It's important to understand each four of these things in detail, and to deliberate that how we are going to really apply the particular contract which might contain lease or not. So we need to study a contract from these four perspectives. So first, talking about the right to control the use of asset. So. So the lessee should be able to obtain substantially all the economic benefits and direct the use of the identified asset. So what does direct the use of the identified asset means? That so the lessee should have the full control over the direction over how to use that particular asset. It should not have some terms and condition attached to it. So many a times it happens that the seller or the lessor might give some conditions or restriction to use the asset. So in that case, we need to see that are there any conditions? The conditions are there still on a contract which excludes the lessee to take this contract as a lease contract. So this is a thought which we need to give at the time of identifying whether there is a right to control the use of asset is established or not. Second, when we come to the identifying asset, so it can be either explicitly specified in the contract or maybe it's being implicitly specified. The standard does not say that this has to be explicitly specified. So so if a supplier has a right to substitute an asset, if an alternative asset can be used, then that has to be taken into the picture while identifying the what asset is there in the lease, right? So if the supplier can substitute alternative asset, and the supplier would benefit economically from exercise of its right to use the substitute asset. So what does it means? Suppose the lessee has taken vehicles on rent, so maybe cars on rent for that matter, and uh, uh, and and the lessee has already identified this. The lessee, maybe say lessee wants some particular number of cars to be fly from this location to that location, but the seller but the lessor has the right and the option to whether to replace that particular vehicle with any other vehicle, and if he deems fit that he needs that vehicle for another purpose which might give him more benefit at that point of time, rather than entering into a set contract with that particular lessee. So if there is a alternative use of the asset is available with the lessor, so then that consideration has to be given to see whether there has been an identified asset or not. So this is the thought, what's standards say that we should be able to identify what asset is there from which we will be deriving the benefit, right? So this third point is the period of time. So the period of time, as I shared earlier also, that many a times the contract is entered with a lock-in period of maybe, let's say, 3 years, and with the option to extend or the option to terminate. So we have to see that whether there is a reasonably certain it is reasonably certain that this option will be taken to extend the option to extend will be taken, or the option to terminate will not be taken. So if that is the scenario, we have to consider the whole length of the period of the contract, and accordingly do the accounting for the leases. So last point is pretty clear consideration. Obviously, if there is no consideration, there is no point of getting into the agreement. So consideration can be either fixed based on usage, sales, or etc. So moving forward, I have prepared a little decision tree for all of you to understand and see that how we can quickly see whether the contract contains a lease or not. So if we have to start, so is there an identified asset? If the answer is no, then we ending to that contract does not contain a lease. If the answer is yes, has the customer the right to all substantially has a substantial right to all the benefits. If there are terms and conditions to it, if there is a doubt to it, if it cannot be economically feasible, so then the contract does not contain a lease. If it is yes, then there is that all the benefits goes into the pocket of the lessee. Then it is then the next question comes into the picture, is that who and how that asset has to be used. So who directs and how? What is the purpose? Is there any terms and condition attached to it or not? If supplier has the control, so then this contract does not contain a lease. If the customer has the control, then definitely it can be counted as a lease. So this decision tree matrix is something which summarize our general concerns of how to enter into how to study a contract, which contains these. I hope if any one of you has a question on this slide, please feel free to ask. So moving forward, I thought I'll stay here on this slide so that everyone can look at it and try to understand that how they need to navigate through this decision tree. And I thought that this might be more quick and relevant for you all to make a decision with respect to the question that you might come. So for your sake, there is there is an example which I thought I'll share with you all. So let's say that a customers enter into a contract with the supplier for the usage of a specified ship for a period of 5 years period, as per the customer's discretion, whether it's a contract or not. So this specified ship is identified in the contract. This is the first requirement as per the decision tree. And neither does the supplier has a substantive substitution right over it. So it cannot be substituted. This ship has to be this ship. It cannot be like any other ship. The customer occupies substantially all of the ship and therefore has the right to substantially all the economic benefit from use of the ship during the contract period. Customer make relevant decision about whether, where, and when the ship sails, subject to contractual restriction designed to the project supplier investment. Although supplier operates the ship, but it is in accordance with the customer decision regarding how and for what purpose the ship is used. Hence, it is a lease of ship for the contract period. I hope this makes more sense to I believe that it has given you much more confidence on how to take lease or contract. How to study a lease contract, whether how to identify whether there is a lease in the contract or not. Moving forward, I think now we are coming to the practical aspect of lease. So as I shared earlier in the the second PPT, second slide, that there will be either a finance, there will be an asset, and there will be a liability. So let's understand that how we need to record the liability in our balance sheet. So there are two aspects which standard talk about. First is the initial measurement, and second is the subsequent measurement. So if we have to discuss of the lease initial measurement, then what is lease liability? So lease liability is basically the present value of all the lease payment which the company wants to recognize. So let's say there is an agreement of 3 plus 3, 3 plus lock-in period and 3 more period for the option to extend, and there is a good possible chances that the company might go for the extension. And so for 6 year period, what all the lease payment are there, the present value, the lease liability will be equal to the present value of all the lease payment, right? So there are further additions to it. What might be included in my initial measurement when I calculate lease liability in my books of accounts. So apart from this, there are certain fixed payments, which includes in substance fixed payment less any incentive receivable. So if there is any incentive, then that has to be reduced. I would say to the in the coming scenario, because of COVID-19, I'm sure that the many lessors will be passing on some incentives to the company. So because of which the company might have to consider them either as a modification to the contract, or might have to inculcate that particular change in their own lease model. So please mindful of this fact that in coming scenario, coming days, more incentive might be coming. So I will be covering this aspect towards the end of my discussion. So moving forward, whether there is an option to purchase. So if there is an option, and as we know that if when we have studied in our basics about AS 19 about finance, there is an option to purchase. There is an option to purchase that amount has to be taken care of. If there is any residual value guarantee, then amount which is expected to be paid needs to be taken care. If there is any termination option or penalties attached to it, then that amount should be taken care of. And lastly, if there is any variable lease payment, then only for index or rate at commencement. So what does it mean that index or rate? So many a times, like, our lease, like lease payment, if their lease payment are based on index, maybe consumer index or another indexes, only that has to be taken care into the picture and not based on the turnover or usage. So uh, uh, in one of my client, I saw that the retail outlet was based on fixed rent plus 10% of the turnover. So that 10% of the turnover need not to be covered, right? Need not to be taken care, because that will in any way come into that particular the financial year in which it is incurred, because it cannot be estimated so prudently. From that perspective, only variable lease payment which are related, which are linked to the index, needs to be considered. So all these things has to be brought into a year zero, and it needs to be discounted to the year zero using the implicit rate of return or the incremental borrowing rate. So generally, like, what we used to do is that we used to invite quotation from bank. What is the borrowing rate which the bank is willing to give to a company, that and on basis of that borrowing rate, we used to discount the leases. So if incremental lease of implicit rate is not available in the lease, if the company is not able to identify that implicit rate which is there in the lease, so I think this method, there is an option that we can go for the incremental borrowing rate, and I think that makes more sense and more ease out our worry about how or at what rate to discount our liabilities. So what is the subsequent measurement? So lease should accrete the lease liability with interest and reduce the lease liability with lease payment. So basically, what we are following is the EIR method of accounting, right? So if I at the present date, at the year zero, my lease liability is 100 rupees, and year on year I have used an incremental borrowing rate of, let's say, 10%, then I will be reducing the my lease. I will be increasing my lease liability with 10%, and at the same time reducing my lease liability with the payment of lease rent. So this is how my lease liability will move subsequently. It is also important to note that from the perspective of Ind AS 109, my lease liability will form part of financial liability. However, IFRS 7, if I'm not wrong, IFRS 7 excludes in lease liability to be disclosed at at fair value, because in any way this lease liability is at the fair value. When we record this lease liability, it is at fair value only. So moving further, recognition of leased asset. So what is lease asset? Basically, the lease asset is the sum of the lease liability which we just read, which we just understood how to compute. Second, adding to it, is there any payment made at or before the commencement date, less any incentive received. So incentive received, many a times it happens that the brokers, suppose there is an arrangement with the broker, and over a period of time, the management is able to negotiate with the brokers and have the refund of their brokerage. So that has to be reduced. So this is what practically this I saw in one of my projects which I was doing, and so I thought I'll share this experience of mine with you all, that what incentive received, because many a times we come across some terms that we are not very sure how this terms applies to the real life. So second, adding to it is the initial direct cost, as I said, that brokerage part, and further adding to it is the dismantling cost. So again, dismantle cost has to be brought into the at the present value, because it is a cost which will be incurred in the future. So this is the how we are going to recognize the right of use of asset. So what India's 116 says that we have to create an asset and a liability as I'm again sharing, because it wants the company's true picture to come in the balance sheet. So there is no hidden charges or hidden commitments. Subsequent measurement. I think this is important to understand what's about from the perspective of right of use of asset, because any asset which is being recorded in the balance sheet from the management and from the auditor perspective is open for so many questions, right? Because liability is still fine because we follow accrual basis of accounting and we follow prudence basis of accounting, and because of which liability doesn't comes into much questions. But when as a time when we record some asset, there are many questions whether this asset will reap certain benefit to us or not. So what India's 116 says that there are four ways, we can continue with our right of use of asset. So first is the at cost, which we just studied, at the initial recognition. So that is the same thing, which has nothing to do. Either we can continue with this cost, and which we need to amortize over the period of life. We can choose what life of asset we want to use, maybe 5 years or maybe the period of lease, whatever it is. So mindful of the fact that suppose if you have an office on lease and you have recognized India's 116 on that particular office, and you have also incurred some leasehold improvement to it, right? Furniture fixtures or maybe lighting, electrical fittings, whatever have been done to modify to your own customization. And if that leasehold asset is being amortized over a period of 5 years, and at the same time my lease asset is being amortized over a period of maybe say 9 years, then I think that doesn't make any sense, to why not to I harmonize both of these things. So how in most of my clients, I try to do that, both these things are harmonized, because it is the same asset. I generally avoid doing different class of accounting. So it's open to everyone. It's open to management how they want to use that the period, how they want to recognize that period. So generally, this is what I follow in my own clients. Second is the revaluation of lease asset. So what is important to know that the asset which I will be recognizing as right of use. So the company already have those assets. They already own those assets, similar asset, and they are using revaluation method on those assets. So needless to say, the revaluation method will be applied as per India 16 PPE to that class of asset also, right? So let's say I was doing one of my client which they have their trucks, and they have 500 fleets of truck owned by them and 1300 fleets of truck rented by them, taken on rent. So when I did lease accounting, and they were applying revaluation to it, because they need to they presume that their trucks cannot be carried at cost because they get depreciated so quickly. So they use the revaluation method. So when I applied India's 116, I had to subsequently recognize the lease asset according to that particular class of asset only. I could not carry the lease asset at cost only. I have to revalue them as per the as I was doing for my own asset which I have purchased them, right? So I thought so this is the about the revaluation method. And third is the fair value, which is related to India's 40. And not much I have dealt with it in particular. I think it's talk about to recognize all the investment property at fair value at every balance sheet date. So if that so what I understand that uh, uh, so if the management has strategically chosen to procure a lease, to procure a lease. So if they feel that, you know, in going future, that particular warehouse or that particular office might be their strategic move. However, they have no intention to put that asset into use for their own businesses. So they are more or less like putting that asset into as an investment, which as a result my impairment, as a result, the Ind AS 40 might trigger, right? And the board has approved that, you know, this is the strategic move, and there is no economic benefit by which might flush into the companies after procuring such lease. Then this lease has to be recorded at fair value. So this is like, you know, the three models which are there, which standard has like, you know, emphasized on how to recognize the lease assets subsequently. Only and only other factor is that, you know, we need to consider the impairment of the recognized asset as per Ind AS 36. Modification to contract. So I'll be quickly moving to this part. However, I feel that, you know, in the interest of time, and like, you know, there are much more topics to be discussed. So modification to contract, if we can separate the modification from the original contract, then please account separately at cost. If we cannot separate, if we are not it's practically not possible for us to separate, then allocate the consideration in the modified contract and over the period of lease, and remeasure the lease liability. So this is a little idea on the modification aspect. So other aspect includes, I have two things to discuss with you. First is the composite contract, and second is the lease or sale back. So composite contract, we most of the time we comes into the contract and enter into a contract where there is a service aspect of the contract is also there. Let's say there is a building, in and where we have where the particular floor has been taken on lease. Along with that building, the company has to pay the lessee has to pay a certain portion of the common area, and also company has to pay some certain portion related to property tax, or maybe some other insurance, let's say. So all these things become part of the total lease contract. So Ind AS 116 says that, you know, these four aspects needs to be accounted very separately. And these Ind AS 116 says that the costs such as property taxes or business insurance needs to be apportioned among the identifiable asset according to the ratio in which the prices are given, standalone the prices are given. If that is not possible, the entity may choose to account the whole contract as a single component. You know, so this is the practical expedient which Ind AS 116 gives. It's like a kind of a more of a leverage to the entity to apply Ind AS 116 in in totality. If the entity is not able to figure it out, you know, what portion of common area is there, or what portion of their own specified asset is there, what is the other charges which is embedded in the contract, you know, most preferably it is shared that, you know, the entity must be able to identify standalone prices and then allocate. If it is not possible, then they can do a single lease component. They can take the entire asset as a single component. So moving to the further sale or lease back, you know, what sale or lease backs from the from Ind AS 116 says give reference to the Ind AS 115 revenue from contract. So if the sales qualifies, how we need to recognize the asset. If sale does not qualify under Ind AS 116, how do we need to recognize that asset? So there are the two bifurcation which the company which Ind AS 116 like share. So like, you know, so de-recognizing, if the sale qualifies as under Ind AS 115, So what does qualifies under India's 115 means that the control and the rights and obligations have been transferred. There is no restriction to it, and I'm sure that we will understand it more clearly in our next session, that what sale under India's 115 is. So just sharing a brief highlight that the company needs to de-recognize the underlying asset, and recognize the sale at fair value, and recognize only the gain that relates to the rights transferred to the buyers or lessor. Recognize right of use of asset as proportion to the previous carrying amount of underlying asset. Recognize a lease liability. So if the sale does not qualify under the Ind AS 115, then it is the same way that we have been studying right now. So that it's as if taking a fresh transaction. So there is nothing to do with what we already have in our books of accounts. Impact of COVID-19. So I think we are heading to the last part of our PPT. And however, I just wanted to share that the few development which are happening in the world around, as we aware that there is so much economic hardship is being there is the economy has been gone for a toss. So there might be chances that our lease agreement might go for a change. There might be concessions coming in our way, in the way of the lessee. So what I am sharing is the extract of the analysis which our institute has shared couple of days back. So maybe we can go back to that analysis which is available on the site of ICAI. And it says that changes in the terms of lease arrangement or lessor may give some concession to the lessee with respect to the lease payment, rent-free holidays, etc. Such revised terms of concession shall be considered while accounting for leases, which may lead to modification of leases. However, anticipated revision should not be taken into account. So it's important to understand that it should be an actual transaction and not just anticipation. It's not just assumptions that there might be some change, there might be some concession. It should be manifested, it should be uh, entered into. Then second, also there is a high chances of a variable lease payment to get impacted. So that also needs to be considered in our accounting. Third is the discount rate might change. Let's say the bank borrowing rate currently before lockdown was 10% for a 3-year contract, right? And now because of the lockdown, it has increased significantly to 11.2%. So then the discount rate has increased significantly. So this might we might need to picture in these kind of scenarios also, and what are the risks associated with this, and and accordingly account for the correct value of my these assets. So also it's just a deliberation that that company might receive some compensation from the government, or in a way which might have been received to the lessor. So the government may provide some concession to the lessor, and eventually the lessor will provide some compensation to the lessee. So accordingly, we need to understand whether that compensation would form part of my modification to the lease, or whether it should be form part of as a government grant under Ind AS 20. So accordingly, the decision has to be taken in keeping in view what are the terms and conditions attached to those compensation. So this is what I thought I'll share with you. I'm sure that it will help you out for in applying the Ind AS 116 without any hesitation at your workplace. So any questions, please do share.
Hello.
Yes.
Then there are around 50-60 questions. So if you can see the Q&A from there, you can see and reply, or would you like to speak questions for you? So I can speak.
I am actually not able to see the Q&A part.
Okay.
Just a second.
From your desktop also, you are not able to see?
No, I think that desktop got disconnected for some reason. and
Okay.
I think it was some time limit to it. I don't know, but I'm working through my phone only.
Okay.
So if it is possible, can you share any question with
Yeah,
like
I'm asking.
on?
Uh,
Yeah,
there is one question that can you please share the please explain the P&L impact and balance sheet with some examples.
yeah. So basically, let's say that in our previous scenario we have a lease agreement of, let's say, 100 rupees per month. So what used to happen that when we account for that particular lease, our rent expense was how much? 100 into 1200. So in my P&L, that 1200 was part of my other expenses, right? And my PBT was decreased from rupees 1200. However, when we go into the to the Ind AS 116 and apply Ind AS 116, then what we need to do is we cannot just take away rupees 1200 into our P&L and do away with it. However, what we need to analyze is to see that how the for a period of length of for the period of time the contract is there, like let's say my contract is there for six years, then every year I'm going to incur 1200, 1300, 1400, 1500. Then every year's expense I need to bring back them to the year zero at a present value, which will be my lease liability, and at the same time that equivalent amount will also become my lease asset. So let's say 3000 becomes my lease liability and 3000 becomes my lease asset. So what I will be now doing year on year is that I will be adding interest portion to my lease liability. I will be making it 300, 3030, reducing 1200 for my lease liability, and every year, or what are the rental expenses is there every year. And at the same time my depreciation, at the same time my right of use of asset, which is an intangible asset, will be depreciated over a period of lease or a period which company deems fit. So so this is how my P&L and balance sheet will go. So if I come back to my earlier slide, I just share with for your benefit again. So if we see, my depreciation is fixed now. Instead of my lease rental, my depreciation is fixed, and because of the time value of money, interest expense will be there. Initially there will be huge interest expense, and gradually it will decline as and when my loan or my lease liability will reduce. So this is how my P&L is going to shape up in the over a period of lease. So I hope that I make sense.
Yes. Yatinji, I'm asking one thing. Are you available in the second half as well?
Yes, most likely I'm available.
So what we can do, Sushil sir can start his deliberation, and in the meantime, I'll help you to see the Q&A. So you can
Sure.
reply by messaging, or you can reply them by voice as well, so that we can save
Sure.
time, because the Q&A has been increasing. It's been more than 75 open questions I can see.
Okay.
And on the YouTube also there are many queries. So I'll let Sushil sir start the deliberation. I give you call, and so that you can also reply in the Q&A.
Sure.
Okay. Sushil sir, over to you. Sir, you can start your presentation and deliberation, sir. If you want to share the PPT, there is a share button. You can see in the Zoom.
Yeah. Hi.
Hello, sir.
Hi. And now you are able to see the PPT.
Yes, we are able to see. If you can do the full screen, it will be better.
Hell yeah.
Now it's better.
Yes, yes, yes.
Yeah. Hi. My name is Sushil Fogart. I'm just giving an overview of Ind AS 115, because Ind AS 115 itself is that much huge. The interpretation and understanding of that giving in a session is practically not possible. But however, I can explain the major things with respect to Ind AS 115. try to explain major things with respect to Ind AS 115 in this presentation. Then I cover the agenda of the Ind AS 115 in eight sections: basic understanding, Ind AS 115 revenue recognition criteria, presentation of contract assets and contract liabilities, disclosure, comparison with IFRS 15, comparison with AS 7 and AS 9, comparison with Ind AS 11 and Ind AS 18, and the service concession arrangement, which is a part of Ind AS 115 itself. Okay, that is the basic understanding. Timetables. Ind AS 115 notified by MCA on 28th March 2018, which is effective for the period starting from 1st April 2018. Means in case of the companies where the period ended is 31st March, it is effective from 1st April 2018. And with respect to the companies, say for the period ended is different from 31st March, say it's for 31st December, it will apply with respect to the financial year 1st January 2019, because the accounting year which is started after 1st April 2018. There is a disconnect between IFRS 15 and Ind AS 115 applicability, because IFRS 15 applicable from January 1st 2018. It's a prior to the applicability of Ind AS 115, because Ind AS 115 notified by MCA subsequent to that, and it become effective from 1st April 2018. Okay, and the Ind AS 115 replaced the existing two standards, which is there Ind AS 18 and Ind AS 11, that is revenue and construction contract. There are two standards earlier in Ind AS which is replaced by the Ind AS 115. These are the basic changes, new obligation for revenue recognition applicable to all activities. Before Ind AS 11 before the application of Ind AS 115, there are two standards, Ind AS 11 and Ind AS 18. In case of service contract and in case of construction contract, revenue is recognized based on the percentage completion method. And in case of Ind AS 18, the revenue concept is there, which is there in the AS as well, with respect to that risk, when the risk and reward with respect to the goods transferred, on the basis of that revenue is recognized. However, it's a in case of Ind AS 115, the emphasis is given on the control. When the control is given for with respect to goods and services are delivered, the revenue in that case got recognized. So that is the difference between Ind AS 115 and AS 11 and AS 18, because we are familiar with AS 11, AS 18 concept, because these are the same same with respect to the concept there in the old AS, Indian accounting standards. Little bit changes be there, say a service concession arrangement, and those things got explained in this in these standards, which is not there in AS. Okay, application in case of transition requirement, there are transition requirement with respect to Ind AS 115. In that, it's started Ind AS 115 started from 1st April 2018, and there are two options which we already discussed in during the course of Ind AS 116. But however, I can explain again it. There are two approaches with respect to application of Ind AS 115. One is the retrospective approach, and another one is retrospective modified approach. Another one is retrospective cumulative approach. There are two approaches there. The difference is that in case of retrospective modified approach, we recognize the whatever differences arises on account of modification in the existing on account of accounting with respect to the existing contract need to be recognized on the first day of the financial year. And in case of retrospective cumulative approach, the impact of that is given in the previous period financial statement. Ultimately, the impact goes in the cumulative impact of the changes will goes in the reserve and surplus of the previous year financial statement in case of option 2, and in case of option 1 it goes in the current year. No previous year number will change, only in the current year it will give the impact. Now there are some exceptions which is mentioned in Ind AS 115. It's written in because the other standards covers those things, so those things were excluded from Ind AS 115 to create, and it's mentioned in Ind AS 115. These are the lease contracts which is covered in Ind AS 116. If the contract is covered in Ind AS 116, then it's specifically excluded from the applicability of Ind AS 115. And for that we need to see Ind AS 116. If the contract not covered in Ind AS 116, then it will cover in Ind AS 115. That we need to assess. In case of insurance contract which is covered in Ind AS 104, financial instrument or other contractual right or obligation, those were covered in Ind AS 109, and consolidated financial statement, joint arrangement, separate financial statement, investment in associate and joint ventures, which accounting disclosure, other things disclose mentioned in the other accounting standards. In that case, it is not applicable. The Ind AS 115 is not applicable to those things. Non-monetary exchange means the same line of business. Say generally these sort of transactions I have not seen in my practice, but it's a be there. That's the reason it's mentioned there, because in case, say example is also there, in case of two oil companies, when it's a similar nature of service, if provided by the two companies, and if considering the market constant, they exchange they deliver a product at one location by one company and fulfill the requirement of another company at a different location. In that case, those contracts, those mutually exclusive contracts are not covered in Ind AS 115. It may happen further, it may also happen that some of the contracts will cover in Ind AS 115, and some of the contract in a contract, some of the part of the contract will cover in Ind AS 115, and some of the part will not cover in Ind AS 115. In that case, we need to segregate the contract, and we need to assess it separately with respect to the part which covered in Ind AS 115, and with respect to the part which is not covered in Ind AS 115, we assess it in the different standard. Just wait a minute. Okay. Okay, changes from the previous standard. In case of Ind AS 115, revenue is recognized when the customer obtain the control of goods and services. Under Ind AS 18 and Ind AS 11, it's mentioned there, the revenue is recognized when risk and reward is transferred. So that is the change basically in the concept for the revenue recognition, and that concept gives a lot of differences between the concept we uses earlier for revenue recognition. In case, secondly, when the customer, the control obtain customer obtain the controls when the customer has able to direct use or obtain the benefit of the goods. In that case, it in some of the companies, when goods are not transferred but those goods are retained by the vendor for producing the goods for the customer. In that case, practically goods are not transferred to the customer, but those were retained retained by the vendor itself for the production for the customer. In that case also, it deemed the goods are used for for the direction of the at the direction of the customers. And with respect to that, we need to assess over the time and at the point of time criteria for revenue recognition. In that case, over the time, revenue is recognized when the contract fulfill the when as per the contract the services criteria fulfilled in phases. Say in case of maintenance services, when maintenance services are given for the contract is for the 1 year, and the milestone assessed on the basis of monthly basis, the revenue recognized when the services part got completed for the month on monthly basis, and invoicing made on monthly basis, and the revenue recognized according to that. And in case a point in time when the whole services considered to be delivered at the completion of the part, so in those sort of contracts we recognize the revenue at a point in time. With respect to revenue recognition, the core principle for revenue recognitions are: revenue should be recognized on transfer of promised goods, means transfer of controls. The revenue because things are mentioned in Ind AS 115 clearly with respect to revenue recognition, that these sort of clarifications are not there in the earlier standards. In that case, revenue is recognized on transfer of promised goods, means transfer of control, means when the transfer of control or is happen, then then the revenue recognition criteria fulfills. Customer obtained, how the customer obtain the control: when the customer has ability to direct use, means the goods either delivered to the customer, or customer got a right to instruct the user of the goods how goods to need to be used. And again, as we discussed earlier, assessment required for over the time and point in time, and the revenue recognized on the 5-step models, which is mentioned in Ind AS 115, which is not there in the earlier standards. And sale of other non-financial assets, say property, plant, equipment, which is disposed during the course of business, then for the criteria of control need to be determined to considering recognition of the sale. It's the same criteria which we use to assess for revenue sale of goods. We need to determine for the sale of property, plant and equipment as well, which is in non-financial assets. Okay, these are the 5 steps which is there for with respect to revenue recognition. We discuss these steps one by one in the next slides. In case of identification of contract, with the customer, so it's a defined standard. It's an agreement between 2 or more parties that create enforceable right and obligation. Here we need to understand when a person sell goods or enter in contract with another person, then it become an agreement. A person cannot be enter an agreement for sale with himself only. In that case, for the execution of contract or for identification of the contract, there need to be 2 or more than 2 parties, and the parties by the contract get an enforceable right and create an obligation. If right is not created and there is no obligation arises on the another party, then there is doubt that that agreement will become a contract for execution. In this case, for identification of contract, 5 steps need to be understood. The party has approved the contract and committed to perform their obligation. The parties can identify each right regarding the goods and services to be transferred. The entity can identify the payment terms. Contract have commercial substance. Here it's a more important thing. The contract which is agreed between the parties other than commercial substance are not covered by Ind AS 115. The commercial substance, we need to understand, the commercial substance is a term which is more relevant in the case of contract to covered under Ind AS 115, because the contract which is executed on account of any other than commercial substance were not covered in Ind AS 115. Say some of the contract between brothers, sisters, husband, wife, and the contract between related parties where the consideration or where the execution of the contract is just made for the sake of love or for the sake of something else. In those cases, those contracts were not covered in Ind AS 115. And for the last one, the collectability of the sale proceeds need to be certain. If it is not probable that the collection will happen, or the entity will receive money or consideration for that, in that case those contracts were the revenue need not to be recognized, or those contracts will not cover in Ind AS 115. Okay. We need here we need to understand, does a contract meet the criteria listed in Ind AS 115? Then the contract is accounted for as per Ind AS 115, and no reassessment of those criteria unless there is an indication of significant change in fact and circumstances. If contract is not meet the criteria listed in Ind AS 115 at inception, continue to assess the then it is not covered in Ind AS 115. Then we need to assess it again, the criteria subsequently meet, then we discuss then if the subsequently criteria if the contract meet the criteria subsequently, then in that case we need to again reassess that contract with respect to Ind AS 115, and assess the obligation of the parties for the transfer of goods and transfer of services, and again and if the criteria is meet, then we recognize the revenue. Otherwise we need not to do anything. In case of identification of contract with the customer, we need to assess combination of two or more contract is contract need to be assessed, because in one contract there are more than one obligation or more than one obligation or more than one fulfillment criteria be there, that we need to assess ki if fulfilling the one criteria we are capable to complete our obligation, then those criteria to be considered with respect to recognition of revenue is one contract. In case of two obligations, say company fulfill one obligation, for example where the company enter in a contract where it supply goods to the customer, and along with this it give a service arrangement for 1 year to the customer, and the prices of those two contracts are separately identified. Two parts of the contract are separately identified and separately executed by the parties. In that case, we need to segregate these contract and recognize the revenue separately for those contract. Here the point we need to take into consideration is it's with the same customer, and it's the same customer, terms negotiated as a package, and contract depend on the performance of the contract depend on the price and performance of the contract, and promised goods and services are single performance obligation in accordance with Ind AS 115. Contract modification. In case of a contract which is executed between a customer, executed with the customer, if there are any change in the contract, that change need to be assessed separately, and if there is significant change or modification with respect to work, price, claims, all those things be there, then we need to assess it, is it the same contract and there is some extension in the work of the contract, or by changing in the contract it become a separate contract. Because if there is significant change in the terms, significant change in scope of work, then it may happen that the contract which is executed earlier changes the whole theme of the contract, and that need to be considered as a separate contract and need to be assessed separately with respect to accounting. Change in scope of work and prices. In this, we assess, are the additional goods and service distinct? Say distinction needs to be established. Is it the same? Say when we enter in a contract with the customer for supply of the goods, supply of X goods in 15 days, and later on, if company or if organization is not able to produce that goods in 15 days and requested them to deliver the goods in 20 days, it's a modification in the contract. In that case, it is additional, or customer asks us to supply 120 goods instead of 100 goods which is ordered earlier. Then in that case, it's a change in the scope. Then we need to assess it. Is it the same contract or is there any modification? So it's the same contract, because then in that case we need to account for with respect to, we need to see the changes. This is not if this is not created a separate contract, we need to do the accounting as per the earlier understanding. But say customer asks us for the product A, which need to be delivered in 15 days, and if we are not able to and the customer, if we are not able to deliver that product in 15 days, then the customer requested us to change the product it with the product B. Then the prices, terms, and all arrangements got changed. In that case, it need to be considered as a separate contract, and modification in the contract need to be accounted for differently. The step 2 okay. Does the contract provide for the transfer of one or more goods? Consider both explicit or identify the performance obligation. In this, we identify the performance obligation by identifying the criteria which we need to fulfill. In this case, we assess the contract, goods and services. Is there more than one contract or services recognition on a single PO? If yes, then in that case, contract and services need to be segregated, and based on the obligation, it need to be accounted for differently. When it need to be differently, we need to assess it. Are the goods and substantially the same and have the pattern of the transfer of control over time, or the method or progress are same? Then it need to be considered as single contract. And when the goods and services are distinct in the nature, it need to be considered as the separate contract. Here need to understand if in a contract, when we transfer goods and services in a contract, and the ultimate obligation is to deliver the product and services, it's a composite contract, then it need to be considered as a whole contract. Say when we transfer when a product is sold and installation services are along with this, so then it's considered as a single obligation. But in a case where product is huge in size and there are two separate arrangement between the parties, in which one is the supply of the goods and another one is the installation of the product, and company is generally selling these two services separately, so So in that case, if the services are offered and sale of goods are offered in a single PO, then also it considered as a separate performance obligation, and both the activities need to be assessed separately. But in this case, we need to identify when when the obligation is fulfilled. If the obligation one of the obligation fulfilled on the delivery of the goods, and another obligation fulfilled on the installation, then it need to be considered separately. But in a composite contract where both the activities obligations ultimately completed on installation, then the revenue recognition of sale of product need to be deferred unless until it got installed. For identification of a good or services that is performed to a customer is distinct if two criteria are met. Either of one that the customer, the promise goods as per identifiable from other promises in the contract. Okay, that we discussed. The same thing is here. In this case, as we discussed earlier, we need to assess it if the contract of sale of goods and sale of services, if these are identified separately, or company is regularly selling these things separately, then as per Ind AS 115, it's a separate obligation, and it's a separate contract, and the revenue of those things need to be identified separately. Warranties in Ind AS 37, if the customer, in case of warranties are associated with the product which generally company gave to their customers, and when they sell, in case of warranty, there are two sort of things we need to assess. If it is sold uniformly to the customers along with the product, in that case warranty become the warranty. If we sell the warranty along with the product, in that case it become a composite contract, and the obligation of that warranty we need to provide for as a provision. We need to assess it as a provision, and liability for the same is created. But in some of the cases, when there is a warranty sold along with the product, and there is an additional warranty sold with the product, in that case additional warranty need to be considered as a separate contract, and in that case we need to defer the revenue which we received, and that assessment need to be made on individual basis, and where the similar nature of contract executed, we need to assess it on the group basis. In step 3, determination of the transaction prices. Transaction prices. This is the third step in Ind AS 115, where the revenue recognition in transaction prices assessment need to be made, because transaction prices comprise, there are variable things, there are interest component, there are non-cash considerations, there are consideration payable to the customers. Those things need to be assessed for the transaction price assessment, because what happens when you assess the transaction prices comprises a lot of things. Say there is defer payment clauses for one customer, the prices for that customer is different from the customer which is paying you upfront cash, and there are some sort of incentives given to some of the customers basis on their performance, some sort of bonuses and some sort of discounts offered to the customers, that need to be assessed for the assessment of transaction prices. In case in transaction prices assessment, we it's another it's important for another factor as well. We need to assess it whether the transaction is between principal to principal and the transaction happen as principal to agent basis. In case it's a principal to principal transactions, it need to be recognized on gross consideration, and in case it's on agent basis transaction, it need to be recorded on commission basis. The indicators for the principal to principal transactions are the primary responsibility for fulfilling the services is of the entity which is ultimately selling, and the inventory risk specific to the goods and services are transferred to the to the customer after transfer of control. The entity has a discretion in establishing prices when the transaction happens, where all sort of decisions are taken by the persons who's doing transaction without taking the consent of the purchaser or the manufacturer. In that case, that transactions is considered as on gross amount basis, and where ultimately the risk of the goods are laying with the previous customer, previous supplier, means previous suppliers. Then the transaction need to be recorded on net basis, because ultimately the seller doesn't have the risk and rewards with respect to inventory, with respect to losses, or uh, with respect to estimating the prices. Then in that case the transactions need to be recorded on net basis, because the person is receiving commission or sort of incentive for making for selling the goods, but the goods will not belongs to him, and the risk and reward of those goods are not with him. It's with the vendor or the supplier. Now, in determining transaction prices, there are variable consideration. The amount of the variable considerations are associated with the sales, which need to be accounted for along with the sale, because variable considerations can be some of the in case of Ind AS 115. In case of earlier years, we assess it based on the expectations, and generally we provide these sort of things as discount provision and or commission, or so sort of things we accounted for separately in the liability, but and in the expenses. But in case of Ind AS 115, when there is any sort of variable consideration which is associated or correlated directly with the revenue, the adjustment of the same need to be made with the sales. But in case of earlier standard, it's estimated later on when we finalize the accounts. But in case of Ind AS 115, when we do the accounting for sale, we need to determine any sort of discount, we offer based on the expectation. So that need to be accounted for immediately the impact of the same need to be given uh, in the sales. For assessing this, we use the historical data, and we do the forecast based on the estimation. It involves the estimation. Earlier, the sale revenue is recognized on the basis the sales made, but here, considering the estimation involvement for the determination of the price consideration, it create a problem when we do for the statutory compliances, when we do our GST return filing and all those things. In that case, it create a problem. In that case, we need to make a reconciliation of that, so that we can easily explain these things later on to the authorities. Transfer only to the extent highly probable significant reversal in the amount of cumulative revenue recognized will not occur in future. Expectation for sale based on uses based royalty. This is an example which we discussed earlier. Determine. When we determine the transaction price, to the extent that it is highly probable that a significant reversal of amount of cumulative revenue recognition will not occur in future. It's the same thing when we recognize the revenue, we make an estimate of what sort of revenue we need to reverse in future, and on the basis of that we need to make an appropriate adjustment in the revenue recognition. This is another important thing with respect to adjustment in transaction prices for significant financial component. When we incur sales, or when we do sales of the goods, generally what happens, there are some sort of credit period offered to the customers, and and that credit period is not then in the normal terms, or not given uniformly to all the customers, or it given uniformly in a particular period to all the customers, and that is the significantly higher than what is expected, what is the expectation of the industry, or what sort of trends are available in the industry. These sort of things are done made in Indian markets during the festival seasons, mainly in festival seasons, and in the other periods as well. Then if there is a significant increase in the credit period, or there is a deferment in the payment, or there is an arrangement with any sort of financing companies where interest free period is offered to the customers for the payment, and ultimately the compensation of that is made by the company, or by the vendor to the financing companies directly. In that case, if any such sort of things be there, then the sales ultimately need to be recognized after giving the impact of that. And earlier, these sort of things, if any sort of arrangement we do with the banker or third parties, then we identify that as a finance cost, and we recognize it separately in interest expenses. Now, considering this, we need to assess it, and we need to first it need to be reduced from sales and accounted for separately. Non-cash consideration. Non-cash consideration, transaction prices determination for non-cash consideration. It is measured at fair value. If in this case, in case of recognition of transaction prices for non-cash consideration, we estimate the fair value of the standalone of the goods and services which the company receives. Means that fair value of the services which is received by the entity, not because in this case what happens, where the non-cash transaction, what sort of non-cash transactions the companies can enter. It's generally with the company in the same nature of operation, or company is in different nature of operation, where say in a media company, one company involved in the print media, another company involved involved in the television media, print digital media. So both the companies enter in a contract where one company give the advertisement for another company, and another company again offer this sort of same sort of services, or the advertisement services to the different company, to the another company. In this case, transaction in this case, the services offered by one company and services offered by another company need to be accounted for by both the companies, because it's ultimately it's negotiation, it's an arrangement between two parties, where two parties, instead of paying in cash, they ensure that one company will provide services to another company, and another company, instead of giving cash, will provide services to another company. In that case, it need to be assessed at fair value. And how the fair value got determined? It need to be determined on standalone selling prices promised to the customer in exchange of consideration. If customer goods are fulfill different contract, obtain control, it's the same thing. If so, entity shall account for contributed goods or services and non-consideration received from the customer. If a customer contributes goods and services, material, equipment, labor to facilitate an entity's fulfillment of a contract, the entity shall assess whether it obtained control of them. And if so, the entity shall account for contributed goods and services and non-cash consideration received from the customer. The disclosure of that need to be given in the financial statements separately for non-cash transactions. Now, allocation of the transaction prices. The determination to determine the selling price of each performance obligation, we need to assess observable price. We need to assess existence of the observable price. If it is there, so best indication of the standalone selling price. And if it is not there, then in case the observable price or prices is not identified, in that case allocation need to be made based on the expected cost plus margin approach, adjusted market price approach. If the selling price is highly probable, residual approach. Allocation of transaction prices situation arises where more than one services are offered, and we need to allocate that or more than one goods are sold, and the allocation of that need to be made for the composite services. In that case, we assess this. After contract inception, if there is change in the transaction prices for various reasons, including resolution of uncertain event or other changes in circumstances, that change in amount of consideration to which an entity is exchanged for the promised goods and services, an entity shall allocate to performance obligation in contract any subsequent change in transaction prices, same basis at the contract inception. If there is any change if there is change in any transaction prices, but there is no change in the contract, the basis for allocation between two services or two goods need to be same, which we identified or we applied at the contract inception. And if there is any change in the scope, we can the entity can change the allocation basis. But if there is only change in the transaction prices, the allocation base need to be the same which we identified at the inception of the contract. And in case of our satisfied performance obligation, means if partly contract got completed and the company invoiced for that or recognized the revenue for that, and if there is any subsequent change in the price of the contract, the revenue for the same need to be recognized when the change in the transaction prices. Now it's step 5. Step 5, recognize revenue or performance obligation when performance obligation are satisfied. The criteria here is, first, the customer in a situation where customer receive the goods and consume the benefit provided by entity performance as the entity perform them, means the services or the goods are consumed simultaneously by the customer. In that case, revenue need to be recognized when the services when the services provided and it is consumed by the customer, and where the entity performance create or enhance an assets that customer control as an assets is created or enhanced. In case an assets is created uh, and it is subsequently transferred to the customer, the revenue is recognized when the assets control of the assets is uh, transferred to the customer. When the when the uh, uh, when the company in a situation where the company entity perform does not create an assets with alternate use, and entity has no enforceable right to payment for performance completed to that date, this is a criteria where the revenue is not recognized unless until control of that assets is not transferred. In this we assess measuring progress toward complete satisfaction of a performance obligation. For PO satisfied over a time, revenue is recognized over a time by measuring the progress toward complete satisfaction of each PO. So the distinct entity performance is transferring control of goods and services to the customer. Single method of measuring PO, where satisfied over a time. In that case, the satisfaction of the performance of the PO assessed as each reporting period, and the services which is completed till the date of reporting date need to be recognized. The revenue for the same is recognized. It happens generally in case of maintenance services or the services, helping services, where the activities are performed or services are given for a particular period of time. The revenue of that is recognized based on the time completion or based on the services provided. Say in case of AMC services, where AMC is given for one year period, and for the period ended it's completed 6 months, then in that case company will recognize based on the purchase order or based on the completed period 6 month revenue for the reporting period ended date. There are two methods by which performance satisfaction of performance obligation is assessed. One is output method, another one is input method. In output method, where the transfer where it is ascertainable that what sort of services is provided and what sort of services is remaining. In that case, on the basis of that, revenue is recognized. How this is assessed? Say for a purchase order or for an contract. In case it is ascertained these much services need to be provided, and it is ascertained some sort of on time basis or on milestone basis the part of the contract is completed, and that is recognized, or the control of the goods or services is transferred or consumed by the customer. In that case, revenue for that is recognized considering how much work is completed. And the another method is input method. In some of the cases where output of the services is not ascertained, but reasonably it can be ascertained what is the expected expenditure which company or organization need to incur for the performance of the services, if that is there and that is ascertained reasonably reliably. In that case, where the resources or cost is incurred, on the basis of the estimated cost, revenue is recognized. It's a output and input method which used for the recognition of revenue. It's the same thing on the basis of sales based or users based royalty. Intellectual property, in case of intellectual property, when how much resources you are consumed, on the basis of that, the revenue is recognized. Now it's these are the five steps for the revenue recognition, which need to be fulfilled for recognizing the revenue. And now we discuss presentation of contract assets and contract liabilities in the financial statement, because when some sort of obligation in fulfilled, or some sort of activities or services or delivery of goods are made, in that case, some sort of assets need to be recognized, or some sort of liabilities obligation arises on the company, which need to be discussed here. Presentation of remaining right performance obligation in a contract on a net label basis are not mandatory. Okay, that's just assess the relationship between the entity's performance and customer payment. Okay, contract assets. What is a contract assets? Entity's right to, just wait a minute. Entity right to consideration in exchange for a goods and services that entity has transferred to a customer, when right is a conditioned on something other than passage of time. Receivables, any unconditional right to consideration. Contract assets and contract liabilities, entity's obligation to transfer goods and services to a customer for which the entity has received consideration from the customer, say, or the amount due, means it's either customer advances or some sort of liability arises on account of non-fulfilling or some sort of defect in the contract. It's discuss about recognition of receivable at contract assets, defining contract assets and contract liabilities. Okay, disclosures, contract assets, contract liabilities, disclosure, and the other things need to be disclosed with respect to Ind AS 115, because earlier the disclosure of the things are not that much stringent in the earlier standards. Now it require more disclosure with respect to contract with the customers. Disaggregation of revenue, contract balances, description of PO transaction, contract with the customers, significant judgment made, timing of satisfaction of PO, and transaction prices, amount allocated to POs, assets recognized from cost, qualitative and quantitative information. These sort of disclosures, it require more disclosure basis of which accounting we do. We need to put the disclosure of those things in the financial statement to give them to give more understanding over the basis of revenue recognition and the criteria for recognition of an assets, which is used by the entity for recognizing revenue. Disaggregation of disaggregation of revenue. Disaggregation of revenue, it's consider information reviewed by CODM, chief operating decision makers. Explain relationship with the segment disclosure, relationship of the revenue with with the segment, and combination of quantitative and qualitative disclosure, opening closing balances, amount of revenue recognized from contract liabilities, explanation of significant changes in contract balances, remaining performance obligation, where performance obligation is not fulfilled or expected for more than 1 year, aggregate amount of transfer price allocated, where some sort of allocation we make in allocation, and we defer some sort of revenue on account of the contract, then the disclosure of those need to be made. Now it's a comparison of in Ind AS 115 with IFRS 15, because there are some differences between Ind AS 115 and IFRS 15 as well, because because in India, as you are aware, in IFRS 15 and Ind AS 115, because Ind AS 115 notified by MCA considering the local scenarios, there are some sort of guidance, some sort of additional things put in Ind AS 115, which is not there in IFRS 15, or the guidance of that is not available in IFRS 15. Say with respect to excise duty, as of now it is not applicable, but still for the understanding, because it require guidance as inserted in Ind AS 115, that entity has to present the amount of excise duty included in the revenue in statement of profit and loss account. Separately disclosure required for excise duty, which is not there in case of IFRS 15. Reconciliation of revenue recognized in statement of profit and loss account with respect to contracted prices. There is a guidance on determination of transaction price and amount allocated to performance obligation in case of IFRS 15, but that guidance with respect to Ind AS 115 put some sort of additional things which need to be disclosed separately. These are adjustment made in contract prices on account of discount, rebate, refund, credit, price concession, incentive, performance bonuses, etc. Sale with the right to return. There is guidance in case of IFRS 15. There is guidance on accounting for or sale with right to return by the customer. Further, in Ind AS 115 has inserted explain accounting in this in case of transfer of control of a product to a customer with an unconditional right to return. So these things are added to give more elaboration, to elaborate more in Ind AS 115. Use of different terminology, because it's the same, because we use balance sheet instead of statement of financial position. We in India we use statement of profit and loss instead of statement of comprehensive income, which is there in IFRS 15. Amount of consideration and amount of consideration, among other things, can vary because of penalties. However, in the Ind AS, penalties are excluded from the list of example given, due to which an amount of consideration can vary. However, one paragraph has been inserted to explain accounting treatment of penalties. Effective date, we discussed that because in the earlier slide it's a different, in context of India it's a different. It's the same thing. Now comparison of Ind AS 115 with AS 7 and AS 9, when it is applicable in case where the entity apply first time Ind AS, or it's become applicable to the entity where it's earlier prepare account in AS, and now due to change in net worth or change in any sort of other criteria, the entity fulfill the requirement of Ind AS, and Ind AS is applicable to them. In that case, and there is difference between AS and Ind AS, so that we discussed. Scope, it's a Ind AS 115, and here AS 7 and AS 9. There are two standards in IGAP which are there for the revenue recognition. One is with respect to contract, construction contract, and another one is sale of goods and services and other things. And in case of Ind AS 115, It's only single standard that where where it deal with the revenue recognition. However, because in India's there is different standard with respect to assessment of financial assets and financial liabilities and income recognition, Ind AS 109. So in that case, that is interest and dividend income are covered in financial instrument standard, which is not covered in revenue recognition standard. Multiple element contract, as there is no some sort of guidance be there. Everyone apply their own knowledge and understanding with respect to accounting of multiple element contract. In case of Ind AS 115, there is a guidance and it give recognition to the multiple element, and also explain the criteria which need to be fulfilled for the revenue recognition, which is not there in India in AS7 and AS9. And with respect to principle of revenue recognition, AS7 and AS9 not provide any overarching principle to fall upon in case of doubt. In case of Ind AS 115, it's more elaborative, and it give more guidance with respect to principle of revenue recognition and in the measurement of revenue. In case of AS9, revenue is measured when services goods are supplied or services rendered to them, and by changes in reward arising on uses of resources. In case of AS7, revenue is recognized as construction progress, means and there is a guidance note with respect to percentage completion, POCM, for recognition of revenue. But in case of Ind AS 115, it's a comprehensive standard. There is no additional guidance note sort of things be there, and revenue is measured with respect to transfer of control and transfer of the goods and services, and excluding, and it gave the guidance with respect to recognition of revenue on net basis.
Sushil sir, sorry to interrupt
Cost
you.
to obtain and fulfill a contract. No guidance is provided regarding capitalization of such cost. There is a guidance with respect to recognition of cost
Sushil sir,
to obtain, fulfill a contract as an assets. And that is with respect to basically majorly for large contract, which is deferred in a case where revenue for that contract is recognized over a period of time, and there is some sort of initial cost company need to incur. Then
Sushil ji, sorry to interrupt you.
Cost deferment of that cost need to be recognized over a period of time, considering the matching concept.
Sushil sir, I'm saying we have
point of revenue recognition.
Sir, can you hear me?
It's the same as we discussed. In case of AS9, we recognize the revenue when significant risk and reward of ownership is transferred. In case of construction contract, it's construction outcome can be reliably measured. Contract revenue recognized when stage of completion of contract activity at the reporting date. Considering these factors, we recognize the revenue. In case of Ind AS 115, we recognize the revenue on single concept model. It's control is transferred to the customers, where the control is transferred to the customers. Service concession arrangements, no guidance is provided. However, a draft guidance notice is issued by ICI, but that is not mandatorily applicable. But in case of Ind AS 115, it's itself described in appendix with respect to service concession arrangement and its disclosure. Okay, disclosure requirement. There are limited disclosure.
Can you hear me?
Yes, 7 and AS9.
Hello?
With respect to Ind AS 115, it contains extensive disclosure requirement as compared to AS7 and AS9.
Sir, can you hear me?
Now it's a comparison with the old standard with respect to Ind AS. Ind AS construction contract and AS construction contract and revenue. Model of revenue recognition. It's a separate model: construction contract, goods, services, dividend, royalty, and interest. In case of Ind AS 115, it's a single model: satisfaction over a time or satisfied at a point in time and over the time. This is model used. Timing of revenue recognition. there is more focus on risk and reward and limited guidance on various topics. In case of Ind AS 115, there is separate element, allocation of transaction prices, variable consideration, licenses, options, repurchase arrangement, purchase principal versus agent assessment, customer loyalty programs, warranty, and capitalization of contract expenses. It's a more elaborative standard as compared to the earlier AS 11 and Ind AS 11 and Ind AS 18. Now it's a distinct good and services. Less guidance provided in case of distinct good and services, more detailed guidance with respect to distinct.
Hello? Hello? Sushil sir, can you hear me?
Okay.
Sushil sir, can you hear me?
Okay. Transaction prices are measured at fair value.
Hello? Sangam ji, can you hear me? Sangam ji, can you hear me?
Deepak ji, I can hear you.
I think Sushil ji is not able to hear me.
I believe so.
Sushil
Hello.
sir, can you hear me?
Yeah.
I was saying, sir, we have many questions are also pending, and we have time till 8:30 only. So I would request you to take the Q&A as well, because Yatin has almost replied for his queries. So there are around 50 queries pending. So I request you kindly take these queries as well.
Okay, not an issue.
Can you see the Q&A box, and if you can reply from the bottom?
Deepak ji, some query belong to AAS 115, Ind AS 115, which belong to Yatin ji also.
Yatin ji's queries I'm replying in the text message. So
But
I think till now,
for lease Ind AS.
Till now we have replied approximately 80 queries. Rest also I'm replying. In the meantime, I request Sushil ji to take the queries from the bottom.
Okay. So in that case, I stop share my screen.
Yes.
Okay.
So can you see the Q&A box, Sushil ji?
Yes.
From the bottom you can start, sir. I think Satish Kumar is asking one query. From there you can take the query.
Okay. Whether the standard apply to AGP sales. What is AGP? I don't know.
Next, sir. Next.
In case of government grant is received, how the same is to be accounted? There is separate accounting standard. I can mention here, or I can speak out.
Just speak, sir. Just speak.
Just speak. There is separate accounting standard with respect to government grant. In respect to government grant, we need to go on that standard. So Ind AS 115 is not applicable with respect to government grant. Okay, I think so. Standard name, I need to standard number. I don't know.
No, you can go for the next question.
Okay. Sir, can you please explain sale and leaseback slide with an example? Okay. The example I need to create it, but in that case, hello.
Sir, it's a lengthy discussion, so I have replied to it. I think it's a lengthy discussion. Maybe on individual basis we can study from the text.
Sure.
In this case, instead of that, if we take the Q&A and we reply to those separately.
Whatever we can reply in yes or no, we can reply, and then those are the lengthy discussion. We can leave it.
Okay.
Like till now, we have replied more than 80 queries. So those which are lengthy discussion, we have left these queries. But those we can reply with yes, no, or with 1 or 2 minutes. We can reply. We have time of 10-15 minutes.
Okay. Is there lease is separate?
And Yatin, you can also see if you can also reply. You can also.
So what is the difference between construction, contract, accounting? In case of construction contract accounting, it's the same. When the risk and reward of the things are transferred, in that case, no, risk and control is transferred, then we recognize the revenue. It's the same principle applies for construction contract as well. Please explain lease equalization reserve. Lease equalization reserve, there is no concept in Ind AS 116. It need to be reversed if earlier recognized. Please elaborate on application of IFRS. in applicability on inapplicability of IFRIC. We are discussing here Ind AS, the IFRS is no relevance here.
Yatin, can we ask you one or
Yogesh.
two queries of India's which is regarding the lease?
With respect
Yes,
to
please.
significant difference area, old versus new standard, which we already discussed in my slides. Pending sales order at year end need to be disclosed or recognized as assets and liabilities. Pending sales order, if pending sales order with respect to that, if it is an onerous obligation.
Yatin, now I'm asking queries from you. What is the difference between rent and lease? If you can elaborate little bit here.
I could not understand difference between rent and lease from what perspective it has been asked.
Okay.
I think
And
both of them are used interchangeably.
how assets under lease are considered under Ind AS 40?
India's 40 is for the, if I'm not wrong, as a investment property. So basically what happens when companies strategically acquire some property which is not intended for their business model, and just to procure that asset which they foresee in future they might be using that particular asset as an investment as of now. So this India's 40 specifically talks about recognizing that asset at fair value because it cannot be carried at cost. So if that particular lease asset to which it belongs, if the management has no intention of obtaining any economic benefit from it, from the time being it has strategically being procured so that they can be above their competitors and manipulate the society or the market. So for this reason it has to be revalued at fair value.
Okay. And can you please explain the sale and lease back with the help of some examples?
Again, sale and leaseback is little lengthy discussion. It will take some time to discuss and elaborate and ponder that how it's going to work out. Simple, it's a simple in a simple way. If I have an asset of let's say 1 lakh rupees in my books of account as a, at a WDB value, then I have to then I sell it to the to the customer or to the buyer, and then I take it back from that person in form of leases. Then I'm actually instead of like taking depreciation as an expense in my books of account, I'm actually taking it as a rental expenses. Then India's 116 talks about whether this transaction is satisfied under India's 115 or not. So if it is it is satisfied under India's 115, then I have to re establish right of use of asset equivalent to what I have actually sold it to other. So it's a complex transaction and computation involved on it. So simply, if I have to say that I have to de-recognize the asset which is there in my books of account and recognize right of use of asset which is equivalent to the benefit that I will be giving to the buyer. So that's how the transaction goes in.
Okay. And whether Ind AS is applicable when part of the building is given on the lease?
Part of the building has to be segregated. If it can be segregated, it should be segregated. If it cannot be segregated, we have to look into the contract how it has been shaped up. So what from my experience, I think we need to segregate it first.
Okay. And any practical example with the rent of office and deposit and brokerage paid and how to work out depreciation and interest if it's not a lengthy discussion?
I think it's we have for like the entire slide is on the discussion of this only.
Okay, so
Only
they
for the
can.
security deposit, I would say that there is a question number 56, if I'm not wrong, on educational material issued by ICI, and
Okay.
I think that will clearly solve the problem related to security deposit.
Okay. Okay. And let me take one or two questions from the YouTube. Also, there were few queries
Yeah.
on your index. I'm just asking you. Just give me a second.
Friends, I request meanwhile, if there is any query pending in the session, you can email us and WhatsApp us. We will try to revert you from the expert as soon as possible. So sorry for that, due to time constraint, we cannot take all the queries. If still some queries pending, you can WhatsApp us and email us. Thank you. You continue.
Okay. I just wait. What is the difference between risk, reward, and controls?
So it is for the Ind AS 115.
I think so. It is for the Ind AS 115. Not, it has not been mentioned here clearly whether it's
I
for
think
115
it's uh,
or
for the Ind AS 115. So basically, it's a move from previous accounting standard to the new standard where the previous accounting standards ask for the recognition of revenue at the transfer of risk and reward. However, for the new standard, which is specifically on the control, has the emphasis on the control basis. Till the time the control of the asset is not being transferred to the end customer, the revenue cannot be recognized. Like the major change which has been there, major sector which has seen a change because of India's 115 is retail sector. From our experience, I'm like Sushil sir and I both have worked on retail sector and this at one client, and we have seen the derecognition of revenue because of application of India's 115. So all the revenue which has been already recognized in earlier period because of previous accounting standard has been derecognized, and because in India's 115 the revenue criteria was not fulfilled as the end customer did not receive their the possession of the flats or the plots, so the revenue has to be derecognized. So just example for you to have a hand-on experience on it.
okay. Uh, how we can decide the discount rate?
See, discount rate either it is implicit in the lease contract or it can be taken from the banks through quotation, through bank quotation. In my experience, we do not derive. I have not derived any like implicit rate from the lease itself. However, we have relied more on the rate offered by the bank. So you may reach out to the bank and obtain the quotation from bank that how, for a particular length of time what is the rate of borrowing that they has to offer.
Okay, in continuation of the same question, like you were talking about the implicit rate, what do you mean by the rate implicit in the lease or borrowing rate?
Again, it is the and if we go back to our basics of discounting, so it is the implicit IRR which
Okay.
we generally talk about.
Okay, if customers required to pay portion of the cash flows from the use of asset to the supplier, customers still have right to obtain the all economic benefits.
Ideally, if you see, the lease agreement is always shaped in that manner. So obviously, like when we have taken an asset on lease, it is always that we pay back to the lessor from the what we have earned from the lease. So it is the normal scenario. This is nothing which is separate.
Okay, and fixed common area maintenance charges against lease is to be considered while calculating the lease asset and liability.
The standard specifically talks about like segregating these two areas from the specified identified area with the common area. If that segregation is not possible, then we should account it as one as a practical expedient.
Okay, and one last query from the YouTube is how rent-free period will be accounted and considered in case of the parking charges?
Parking charges.
Yes.
Again, it is we have to see if we can segregate the parking charges, or if we have to and on the basis of standalone prices, we have to either incorporate into the single lease model. And rent-free period is generally covered. There is no exemption to it.
Okay. Okay, thank you, Yatin, and thank you,
Thank you.
Sushil ji, for replying the queries and taking 115 and 116 Ind AS very nicely and deliberately. And friends, since there has been a lot of queries and we have tried to reply more than 100 queries, and still, if you have any queries, you can give your queries to us on the email ID which has been shared by Sangamji. We will share these query with the Sushilji and Yatinji, and then whenever we get answer from them, then we will share answer to you. And like in the beginning, also I've already mentioned that we are going to organize one program on the art of living, which is on the Friday. It is very effective program for all of the chartered accountants, because every time we are in the stress, whether because of the workload or because of the client or because of the government or because of the deadlines, we always live in the stress. So we have tried to conduct this activity on the art of living and stress management, and it is by the Art of Living Foundation, which has been founded by the Sri Ravi Shankar ji. So it will be a 1.5 hour program. So request you kindly join all of you along with your family, so that you can take the benefit of that program, and we can have some control on our stress, and we can manage our schedules effectively. Link of the same I have already shared in the chat box. I'm again sharing you in the chat box. So request you kindly join the program. We have very limited seats of the 500, those who will be able to join in the Zoom. Rest, those who are not able to join on the Zoom, they have to join it from the YouTube. So, but we have seen that people want to join it on the Zoom, because you can ask queries directly here. So I've shared the link. Kindly join it again. And I would like to thank you, Sushil ji and Yatin ji. Yes, Sangam ji.
Deepak ji, I want to add here, those who will join through Zoom, basically, they can, we will also unmute some participant and they can ask their
Ask the
direct
query.
query to the members of the Art and Living. And for 30 minutes slot is directly addressed by the Gurudev Sri Ravi Shankar ji. So I humbly request to all the professionals to join the session and increase your knowledge about managing your stress.
And there will be 30 minutes Q&A section as well. We have deliberately asked them to keep a longer Q&A section. So we have half an hour Q&A session. So those queries you have, you can ask your queries. We will unmute you here, those who are in the Zoom. So request you kindly join as soon as possible. Now, I will thank you, Yatin ji and Sushil ji, for coming us on our platform and giving deliberation or such a nice Ind AS 115 and 116. So thank you very much, Sushil ji and Yatin ji, for coming here. And just request you, both of you, please share your PPTs so that we can upload PPTs on our website, studycafe.in. And friends, all the PPTs are uploaded on our website, studycafe.in. Till yesterday, we have uploaded all the PPTs that we have received it from our panelists and speakers. Mr. Bhavesh sir has not used any PPT. I'm getting many queries from the participants that there is PPT of day one is missing. So Bhavesh sir has not used PPT. He has given the live examples in the webinar. So the PPT of day one is not available.
Me
I
too.
will request him if anything he can provide it. Otherwise, we do not have any PPT. We have not used any PPT in our session. Thank you very much, everyone. Thanks a lot. Thank you,
Thank you so
Sushil ji.
much.
Thank you, Yatin ji.
Thank you, Sushil ji. Thank you,
Thank you,
Yatin ji. I
Sangam ji.
express my sincere thanks to you to coming on this platform and share your vast
Thank you.
knowledge. Although these both Indias are very difficult to understand at the beginner level, but you have expressed very lucid manner and make all of understand. As Deepak told, we have received more than 100 queries at different platforms, YouTube and Zoom. That shows session was very much interactive. So thank you very much for coming on this.
Thank you.
Thank you very
Thank
much.
you. Thank you.
Thank you so much for giving the opportunity.
Thank
Thank you.
you.
Thank you.
Thank you, Sushil ji.
Thank you.